Now, with this is, you're going to see a really similar set of slides to last week. And I just want to, there's one bit I'm just going to recap in a lot more detail than the rest. Most of it I'll go through in a fairly summary motion, but there's one section I want to go through because we're getting a lot of questions on it in relation to property, plant, and equipment. And I just want to highlight the point. So subsequent measurement, we've got amortization instead of depreciation, we've got revaluations, and we've got cost model. The difference, the main difference between amortization for intangibles and depreciation for property, plant, and equipment is basically identifying whether that intangible asset has a definite or a finite or an indefinite useful life. That is the critical point. If it has an indefinite useful life, then you do not amortize it. Now, indefinite life doesn't mean infinite. It doesn't mean it's going to last forever and ever and ever and ever, because nothing's going to last forever and ever and ever. What it's just saying is we don't know. We just don't know how long it's going to last for. So in that way, it's kind of similar to land. Land doesn't get depreciated because the idea is land doesn't get used up. Now, is that necessarily true? I mean, you could argue that land, in the fullness of time will disappear at some point, and it probably will. But for our purposes, it's got an indefinite useful life. The other thing is, just because something may have a legal useful life doesn't necessarily mean that is the time frame that you use. So for example, patents will often have, there's I think 8-year-long patents, at least from what I've read. There's patents with 8 years and 20 years. Just because you've got a patent which gives you the right to do this thing for 8 years doesn't necessarily mean its useful life is 8 years. Because if you're working, if that is for sort of some sort of technology in a technology space which is evolving really rapidly, you may only get 2 or 3 years use out of it before that patent is essentially worthless. So you've got to make an economic judgment on it. Is, okay, yes, we've got it for 8 years, but realistically, we're only going to get, I don't know, 3 years out of it, and that's what you use. How much each period? The depreciable amount of an intangible asset shall be allocated on a systematic basis over its useful life, paragraph 97, and that is exactly the same as what we see with depreciation. So there's, if you understand depreciation, you understand amortization, which is really nice. But intangible assets can change, and we have the same two options, impairments and revaluations. Now, revaluation model we'll talk about first, and I actually want to talk about it in a little bit more detail in a second, because this we're getting a lot of questions on, and I just want to cover it again. For intangibles though, even though I'm going to talk about it, you pretty much never see revaluations being done. And you pretty much never see them being done because you can only do them if you have an active market. And intangible assets basically never have an active market. What is an active market? We'll give it 2 slides and we'll find out. Fair value is the price that would be received to sell an asset in an orderly transaction between market participants at the measurement date. Same as last week and week before. How often with sufficient regularity, but what we want to focus on here is this section. An active market has 3 characteristics. 1, the items traded are homogeneous. If you've got a patent, that's obviously not homogeneous. If you've managed to categorize, if you've got customer lists, those aren't homogeneous. If you've got goodwill, that's not homogeneous. You can pretty much, almost every single intangible asset you can think of, it's unique. That's the point of half of them. Well, not half of them, pretty much all of them. Taxi type licenses, poker machine type licenses, those are homogeneous. So those would be okay. Can you find willing buyers and sellers? Can normally be found? That doesn't sound right. Can normally be found at any time. I don't know, does that count 2 o'clock in the morning on a Sunday? I don't think that's quite what they meant, but you get the gist of it. Is there a market for it? Again, there's usually pubs looking to buy these things, there's usually pubs willing to sell these things, there's usually taxi licenses out there, so that would kind of work. Can you get prices? Are they available to the public? Can we find out about it? Yes, you can. Like with a little bit of Google searching, it's not like there's a stock market sort of an aggregated market for taxi licenses and poker machine licenses, but you can find this information out. This is a bit I just want to cover because it's causing a little bit of confusion. So, even though for intangibles we pretty much never do it, I just want to cover it again really quickly with a bit of drawing just to make sure everyone's comfortable with it. So for a revaluation upwards, we debit the asset, we credit revaluation surplus. If we're going downwards, we debit the loss, we credit the asset. And so that's asymmetric. If, however, we're going up after already going down, we get rid of the loss first. So we actually do have a gain. If we're going down after going up first, we actually have a revaluation surplus, and anything extra would go through to loss. So I just want to draw this up again, just as a reminder of what that was, because this is pretty important. So if we've had a $100 million asset, so that's sitting there, and we go down to 70 million, that's a $30 million loss. If we have a $100 million asset and it goes up to 120 million, that's a $20 million surplus. So it's asymmetric. We go down, we get the loss effect, which is profit and loss. We go up, we go to surplus, which is OCI. So that's profit and loss. That's OCI. Now, if we imagine sometime later, we then come up to 120. That change is 50. So the overall change is $50 million. Now, normally, if we go up, that would all go through to OCI. But because we went down first, that 30 is a gain. So we actually get a profit and loss effect from that first bit. And this second bit goes through to OCI, and that's, I'll just put it over here. And the reason why that happens, why we get rid of this, is if you net these out, what we've had is a negative profit and loss effect, the same profit and loss effect going up. So now the asset's at 120, and the net effect is we've had plus 20 to OCI, which is exactly the same as if we'd just gone up and that was the only thing that had happened. So it doesn't matter if we've gone down or we've gone down, 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 up, up, whatever, and we end up here. Ultimately, we've had $20 of OCI. So that's sitting in your revaluation surplus. If we'd just gone straight up, we got $20 of OCI. So that's the asymmetric bit. If you go down, you go through loss, and you come back up through profit and loss until you get rid of it all, then you come up through surplus. Same holds true in reverse if you go up first. If you then come down, this bit is a $20 surplus but negative. So that's OCI. And then this bit is a $30 loss. So we've gone up through surplus, down through surplus, and the rest, that should kind of get to here, the rest goes through to loss. And if you net all of that out, you've had a $30 loss, which is the same as if we just come straight down to 70, we've got a $30 loss. So that's how those two work together. Now this is with a non-depreciable asset. If we want to make this harder, we'd then layer over the top of this depreciation, and you need to be able to do that. So as I said right at the beginning, however you get to the point, we're not too worried, and we will certainly help you get to that point, but you need to be able to do all those questions in the tutorial work. And that may be this sort of stuff with depreciation, you know, things that are going on with it. So if that was just covering stuff that you already knew really well, apologies for taking extra time, but this is something that you need to be able to do. So with impairments, after initial so we've done fair values, which basically doesn't happen for intangible assets. But obviously, we still need to know how to do fair values and revaluations for property, plant, and equipment. And it's the same process. Same process here for intangibles with impairment. After initial recognition, an intangible asset shall be carried at its cost, less any accumulated amortization and any accumulated impairment losses. So cost, less accumulated amortization, less accumulated impairment. Go straight to 136, which is exactly what property, plant, and equipment does as well. You check for indicators, you estimate the recoverable amount. An entity shall assess at the end of each reporting period whether there is any indication that an asset may be impaired. If any such indication exists, the entity shall estimate the recoverable amount of the asset. Now, technically for intangibles, it's actually a little bit different for that. So I know that's a blanket statement for impairments. Goodwill has to be checked regardless. So goodwill, you do an impairment test at the end of every year, and I have to actually, not I have to, I'll let you guys do it. But there's also something about if an intangible asset is important for a cash generating unit, then you have to check those anyway. So for some intangible assets, you've just got to check them every year. Like you've got to do an impairment test regardless of the indicators. Now, question for you guys. How many of you guys use Facebook? I do. Really? You don't? Really? Okay. Interesting. In future reference, if we have any more problem outages with UTS Online whilst an assessment is due, so obviously there's about a 3-hour window the rest of this semester where that's going to happen, please check our social media for information. That's where it's going to be coming out. How many of you guys have a MySpace account? What's MySpace? I've got a MySpace account. Don't know if it's still active, but at least I did at some point. MySpace is a really good example of a situation where, in this case, it was goodwill, but we have an impairment of an intangible asset. Now, judging by the resounding lack of sort of response to people having a MySpace, is anyone, you've heard of MySpace? I know it's going back a while, but you have heard of it. It was the Facebook before Facebook came about, and I had a MySpace account before Facebook, and it was just too fiddly to use. Like, you know, you could personalize it, you could add code to it and change things and do whatnot. And I was like, too lazy. I don't want to have to do all that stuff, and just stopped using it. Facebook came out and was like, yeah, this is a lot easier. This is a really good indication of the fact that no one uses it. And this is going back to 2011. I'm pretty sure that's continued to drop. This is just in the US. Now, why I bring this up is at around about this point in time, Rupert Murdoch and News Corp purchased MySpace, and they spent something like $680 million buying it. Now, if you think of, $680 million, that's a lot of money. You think about what's getting thrown around for Snapchat, for not for Facebook, for Instagram, for WhatsApp, like that's nothing nowadays, but I mean, that was a lot of money. And basically everyone disappeared off it. It got sold a few years back to a consortium of people, including Justin Timberlake. Anyone want to hazard guess at how much those guys paid for it? So News Corp bought it for about, I think it was actually about $580. It was about, say, between $600 and $700 million. How much do you reckon it was sold by News Corp for? It was sold for about 30. Now that meant News Corp, there was indicators of impairment, and even without it, because it was goodwill, they would have been doing it anyway, assuming US GAAP works the same. Let's say it is. They wrote down in about 2009 or so, they wrote MySpace completely off. They just went, this is worth zero. So, on the books, they actually made a gain when they sold it, which is good for them. Actually, have you guys heard of Bebo? Did you hear about what happened with Bebo late last year? Okay. The guy who sold Bebo 5 years ago, he sold it for $850 million to AOL from memory. He just bought it back from AOL. You know how much he bought it back for? $1 million. He sold it for $850 and bought it back 5 years later for $1. That's awesome. He's going to try to resurrect it, but again, he's done well. I think he netted about $600 million out of the whole deal, but still. The recoverable amount of an asset is the higher of its fair value less cost to sell and value in use. So that's important. We talked about that earlier. You need to know this stuff. And the really nice thing is you don't even have to remember it. Paragraph 6, you look it up. There it is. It's been black and white in front of you in the exam. Fair value is defined previously. Value in use is the present value of the future cash flows expected to be derived from the asset. Again, you don't have to remember any of that. It's in the standards, and you will have the standards with you. If the recoverable amount is less than the carrying value, then the carrying value is reduced to its recoverable amount. It's an impairment loss. You recognize that immediately in the profit and loss. Debit impairment loss, credit accumulated impairment. If there are indications that the conditions leading to the original impairment have decreased, you estimate the recoverable amount. If that is higher, you take it back up to the ceiling. Remember that. If this is a depreciable or an amortizable, that's not quite the right word, but if it is a depreciable asset, that ceiling will decline over time. You need to take that into account. And you can bet if there's an impairment type question in an exam, it's going to have a ceiling and it's going to move. I'm writing the exam this weekend. If there is one, that's going to be in there because that makes a question trickier and it picks up those who know the difference of what to do with that. Now, just an example of where this can be is poker machine light. Actually, that's a really good example because a couple of years ago, the government of the day, which is actually not the government we have now, was looking to implement a new regulation around poker machines along with the independent senator, I can't remember if it was a senator or not, but Andrew Wilkie, to say we need to limit basically what poker machines can do and the amount of money people can put through them, which would have a negative effect on the valuations of those licenses because it would affect the returns of those assets. That would be an indicator of impairment because suddenly something has happened which has decreased the value of those particular things if you were using the cost model. So that would be the impairment. A reversal of that would be the new government coming in saying, well, this is just rubbish and get rid of it. That would be a lifting of those conditions and you would see a restatement to what those amounts previously were at. No higher though. And if they were being depreciated, then you need to take that into account. However, for something like MySpace, once you've written off goodwill, it's gone. And that is the difference to what we normally see with impairment reversals. Once it's gone, it's gone. And the idea behind that is that any reversal is due to what you're doing with the business now. And for MySpace, that's what they're trying to do. So if MySpace is starting to come back up, and imagine it is still part of News Corp, they're trying to focus it more, less on social media, but more on a site for bands to get out information. I don't know if it's working. I stopped looking at it a long time ago. But that's what they're trying to do. And the idea is it's not really trying to reverse the previous goodwill, but is actually reversing, MySpace works. Reversing the previous goodwill is actually doing something different. And that's internally generated, and you cannot recognize internally generated goodwill. So there you go. So what we covered, assets do contain information. Management does manipulate assets or do have the incentive to manipulate assets. Regulation hopefully limits that choice, assuming they actually follow the regulation. And what we're primarily looking at is, do you count that asset, do you count that spend as an asset or do you expense it? And if you put it on the books, how much you put it on the books for and how much is kept on the books over time. The reading for next week, have a look at impairment of assets, intangible assets. The tutors will go through question 8.32 and we're looking at natural resources. And to give you the heads up, from here on in, it starts to get more and more technical. Like we've sort of stayed away. We've had 4 weeks. We've had 2 weeks really without numbers. From next week on, we are starting to look at more and more numbers and more sort of calculations as we work through. So if you're not up to speed with debits and credits, you've got probably another week's grace to really get on top of it, and then the rubber really hits the road. If you want to have a chat to me, we've got 20 odd minutes, so please feel free to come down and talk. Remember, if you are in the 8 p.m. tutorial, the room has changed. It is now up in this building. So just make sure you're aware of that. Otherwise, enjoy the weekend. Hopefully have a bit of a break, and I'll see you guys next Thursday.